This is actually one of my favorite panels because I do a lot of work in this area on the enforcement side and some on the counseling side. And so I'm really excited to hear from this group. This panel is going to discuss accounting and auditing issues, some of the non-GAAP things that were mentioned in the prior panel, and tell us what we should be paying attention to in the coming year in this area. I'll introduce our moderator, who is our session chair, Mark Kronforce. Mark is a partner at EY, Ernst & Young's Assurance Professional Practice Group, where he specializes in matters pertaining to SEC rules and regulations relating to financial reporting. Prior to joining EY in 2018, Mark served on the staff of the SEC in a variety of roles in the Division of Corporation Finance, 14 years, including 5 years as the chief accountant. So he will tell you about his panelists, all of whom are very distinguished, and I'm anxious to hear everything you have to say. Thank you.
Thank you. Who's ready for some accounting and auditing? So this is great. We have a celebrity panel, I feel like. So I'll just briefly introduce the panelists, and then we'll get moving on the content. To my immediate left is Manira Carr. She's Executive Vice President and Chief Accounting Officer of Wells Fargo. Next to her is Pat Gilmore. He's a partner in Deloitte's professional practice. Pat also spent quite a few years at the SEC. Next to Pat, of course, is Lindsay McCord, who is the Chief Accountant of the Division of Corporation Finance. And down there at the end, of course, John White, who needs no introduction. If you saw us having a heated discussion out in the hallway, that's because John refused to remove his tie for this panel. So he demanded to keep it on. So let's get going. Lindsay, I don't know if you want to give the disclaimers. We have them on the slide for everybody that their comments are their own.
Yes. Everything I say today are my own views, and in my position as chief accountant of the division, they are not the views of the commissioners, the commission, the staff, or, unless I say the staff, or of the chair.
All right, my clicker is not working, so.
Off to a great start.
Actually, yeah, this is going really well.
There you go.
Who's up there?
You got it up there.
Working up there.
Yep.
You have to go back about 6. Keep going back. More.
It's all the way to the end.
Isn't this exciting? Okay, so this is what we're going to talk about today. Hopefully topics that everyone is interested in. We're going to start with non-GAAP. And we're fortunate enough to have Lindsay up here, who is obviously deeply involved in non-GAAP policy at the SEC, and they just recently revised their guidance, the C&DIs that they have on non-GAAP. That was done back in 2010. It was done again in 2016, and here we are. She did it again in 2022. We often refer to non-GAAP as a pendulum that swings back and forth, and so originally when the rules came out, the FAQs that they had were very, very harsh. We loosened that up in 2010. Then the pendulum swung back and cracked down a little bit in 2016. And Lindsay was hoping that you could talk a little bit about what you did in changing the guidance and what you were trying to achieve with that.
Yes, and as mentioned, this is an all-star panel because in 2016, I believe, Mr. Kronforce, you were the one that issued those updates. And then Pat Gilmore was the deputy chief accountant over non-GAAP and made several decisions too, whether he likes to admit it or not. And then I, after that, was able to get involved. It's an evolving topic. It's very exciting. The three of us may not always agree on the decisions that have been made over the years, but that's why it's such a great topic, is because it's something that involves judgment, and you probably can never issue enough guidance to provide the boundaries of what is non-GAAP and what is misleading. So that was kind of how we approached the updates in 2022 in December. And I can actually say to this group, C&DIs, when I'm at accounting conference, I always have to explain what that means. So I feel great that I can shorthand here to all the attorneys in the room. But we really were focusing on between 2016, the last update, and then now, or what was 2022, what has been the highest volume of non-GAAP comments? that have been issued by the staff, and where am I getting the most phone calls on what does the guidance mean, what does the rules, regulations mean. So we kind of narrowed it down to 3 topics that we updated the guidance on, and then we added 2 new additional questions to the CNDIs. The first topic is one that I'm sure gets a lot of interest with this audience, and I'm probably been on phone calls with some of you about it. It's the CNDI that relates to what is misleading, and specifically there's one example in that CNDI, and it's about normal reoccurring cash operating expenses. First, just to highlight, that's just one example. You can have other things that are misleading, but that example has generated a ton of comments from the staff to issuers, and a lot of dialogue. So when we approached it, we originally started with the basis of what can we do? Should we give the public examples of things we've said that is misleading and objected to over the years, because non-GAAP continues to be the #1 comment space other than MD&A? Could we possibly delete it, maybe even? That was unlikely to happen, but there was a discussion. Or what else can we do to help people who struggle with when am I approaching the normal reoccurring cash operating expense bucket? So the way we approached it was we decided to try to provide some principles of what does the staff think about when they think about what is normal and what is reoccurring. And so as it relates to that, what we said about normal was the things that the staff considers is the nature and effect of the non-GAAP adjustment, how it relates to the company's operations, revenue generating activities, business strategy, industry, regulatory environment. So all of those are kind of like bullet points we laid out in the update to say this is what the staff is going to talk to you about for issuers and for their advisors when we issue a comment asking for more information of how did you think about that guidance in relation to the non-GAAP measure and the related adjustments in that measure. And 9 times out of 10, the first question is this part of a normal part of your business? Is this part of how you generate revenue? And when that is the scenario, then generally we're going to say, well, that seems to fit a normal reoccurring cash operating expense. That would be misleading to include it in your non-GAAP measure. So for reoccurring, that's another piece that has always gotten a debate. What is reoccurring? We know Regulation G and Item 10E of SK, the adopting release in 2003, discuss what is non-reoccurring. And it kind of gives this parameter of you can't label something non-reoccurring if you think in the future 2 years it would happen again, or in the past 2 years it's happened. So anything that kind of would be not non-reoccurring, then that makes it reoccurring. But that still leaves a lot of judgment of what that means. So we just wanted to kind of, we brought out the dictionaries and everything to try to figure out what exactly to tell the public about this. And so we added that an operating expense that occurs repeatedly or occasionally, including at irregular intervals, is reoccurring. And again, that's not a defined amount of daily, monthly, quarterly, or even annually. Because again, if it could happen in any 2 years and you can't label that non-reoccurring, that means anything that's outside of that would be reoccurring. So I'm going to give an example to illustrate, because I'm someone who I do much better understanding things when I have a live fact pattern or example. So the example I've shared, and this is not to pick on any specific industry, it's just one that, again, I think everyone can relate to, is the retail industry. And that is retail industry, as part of their business, in order to make money, it is common for them to have to open new stores. If you are going to generate revenue, you either need to have new products or you need to open new stores. So we have said we would find it abnormal or inconsistent for a retail company to say that the cost that they incur for opening new stores would not be a normal operating expense of their business. Again, because part of their revenue generation, in order to generate revenue, they need to open new stores to get more revenue. In order to their business strategy, it is to grow. There's very few companies that would ever say their business strategy is not to grow at any rate. And then we also said, well, what does it mean for reoccurring? And kind of going back to what I just mentioned, you don't have to open a new store daily, monthly, quarterly. It could be at an infrequent interval, and it still be a reoccurring expense. The other piece about this, again, kind of keeping on the retail industry, was store opening costs, same thing for store closing costs. It is not uncommon for the retail industry to have to shut down stores because they're not generating enough revenue, because they're changing locations. They found a better location in the area. There's a new building opening, and they think they're going to bring more customers. So again, we said that in general speaking, for the retail industry, that's probably going to be something, store closing costs, that would also meet a normal, reoccurring cash operating expense. The last one, kind of to illustrate this point, was the presentation of a performance measure that excludes rent expense when leased assets are integral to a company's operations and generation of revenue. Going back to the retailer, they often rent the stores that they don't often own the store property. And so we would not expect a retailer to be able to make a non-GAAP adjustment to exclude the rent expense for their stores. Once again, not trying to pick on retailers, not trying to say this is an exhaustive list of examples. It's just one that we found when we talk to people about this CNDI. It's one that everyone can kind of relate to because we all probably have shopped at a store and understand the general business strategy and revenue generation of that type of business. And again, you would think about as an industry, they generally are growing their store footprint. And regulatory, there's probably rarely that they're permitted from expanding store locations. I will also just want to highlight one question I received in December, the same day that we released these groups of CNDI updates. I happened to be speaking at what I always call the big accountants Super Bowl conference that it's probably like SRI, but just all for accountants. And a question I received on the Q&A after the panel was, what do I do about restructuring costs? Is this CNDI telling me I can no longer do a non-GAAP adjustment to exclude restructuring costs? And so the way I would answer that is, it depends. In general, you're never going to get a 100% this adjustment is allowed no matter what when it comes to sort of guidance that's based on principles or judgment. However, I would encourage anyone who has a client that is doing a non-GAAP adjustment and they come to you with this question to say, ask them the questions that are laid out in the CNDI. Are you actually running your business, and is your business strategy to restructure? In general, most companies are not excited about restructuring, and it's not how they're generating revenue, and it's not their business strategy. They may be doing it in a somewhat pattern because of other things going on with the business, but in general, we have not seen at the staff many companies that they could say their business strategy and their revenue generation, and also just, again, overall, their industry is to restructure. Not to say that would never happen, but in general, I think people should feel safe that restructuring costs, unless you're in the business of restructuring, would not be something that would meet the principle of the CNDI. I'm going to pause there before I go to anything else.
Let me give you a break,
Yeah.
and maybe I'll take what you're saying and tell you what happens, at least in my industry. I think for all the reasons you're hearing from Lindsay and the pendulum situation that Mark mentioned, at least the banking industry generally just shies away from non-GAAP. We put in maybe a couple of different non-GAAP measures, and that's it. But at the end of the day, you do want your investors to understand what's going on with your results. And so our approach has been to call out the 2 or 3 items that might be of interest or that might be of size, but we don't solve for an adjusted EPS. Now, what this does mean is that the media picks up the results as we state them. So, they are not going to sit there and analyze and make adjustments, and you kind of have to suffer through whatever their take is on the outcomes. I think the places where this becomes challenging for us is non-GAAP shows up, for example, in the CEO's letter to shareholders. It might show up in filings that might be more Reg G than 10E.
Yeah.
And so as a company where we are, because of these changing focus, is best practice we're just going to comply with that higher standard. And so we go through the whole prominence and we go through the reconciliation and explaining why this measure is useful. My observation is, while that may be best practice, sometimes it does cause what might be a plain English communication to become a lot of accounting speak. So I think, here's what I'll say. From my vantage point, I see both sides. I understand where the SEC is coming from, because I've seen some companies like really go over the top with non-GAAP. Entire income statements become non-GAAP. So I hear where you're coming from and fully appreciate.
That would not be allowed.
That's right. I fully appreciate that. But on the flip side, I do understand why companies struggle with what they're supposed to do. Like when we say legal, when we talk about recurring expenses, I'll pick on legal since this is a legal crowd here. Every company has normal recurring legal expenses. But then what do you do in that quarter when you have that sizable judgment or a settlement, and companies want to call out how that might be impacting their results? Because at the end of the day, the analysts are chasing, well, what is your run rate? What should we expect out of you? And unless and until you don't call out some of these items, that might become a difficult exercise. That's just the other side of the equation.
And that's where we definitely encourage, like, I've had a lot of dialogue about MD&A. We would expect people to be calling out these unique expenses or revenue generation activity, whatever it may be. It should be in MD&A, and a lot of times it's already there. And what I hear is, well, we want to do the math, and we'll say, well, unfortunately, that might be an adjustment that would violate the rules in our opinion. So call it out, definitely disclose it, narrative, but you might not be able to do the math for it.
So Lindsay, go ahead, John.
Lindsay, I find it interesting as we lawyers are advising our clients in this space about how I feel like there's going to be a transition with respect to normal recurring expenses, to not non-GAAP them in some cases. I understand that if we have a single new item, we can discuss that and figure it out. But we've got companies that have been following a practice and non-GAPing things out for a decade. And it's one thing if the whole industry moves, but I'm trying to just figure out, how do we advise our clients? I mean, if everybody moves, it might be okay, but everybody may not move. And are we really supposed to have our client apply what you just described and be the first mover within their industry when others don't? And I don't know if I'm directing that at you or at what the accounting firms are going to be advising in this space.
Go ahead, Lindsay.
But, no, I wanted to hear the accountants answer the question, but I know what Lindsay's going to say. But that really is bothering me as we.
Why we did this, though. Like, John, you and I might have had that same conversation earlier in 2022, and it was the concern of how do you move the industry? How do you make sure your client's not the first and only? And the pushback you guys received, that's why it became very important to me personally, again, my own personal views, maybe not the commission or the division's view, was to put out these updates to explain exactly how we're thinking about it. So all of you now have a tool in your toolkit to point to say, the SEC said this. They even updated their guidance on this. So that means they're monitoring it. They're watching. And if any of your clients do not believe we're watching and monitoring non-GAAP, I mean, again, you can show them every audit firm's publication about it being the number one, number two common area for over 5 years now.
Well, I understand it's going to happen in retail. And by the way, because
I know,
given
the moment
that
I give one example, it's all over for that industry.
You know, it's public. I mean, you're alluding to the pharmaceutical industry, which made a change last year.
Yep, the internal research and development.
Okay, but I'm still troubled how this transition is going to happen unless, Mark, you and Pat are going to put out publications to tell particular industries they've got to change, or I mean,
Speaking of
figure out how this is going to flow. We all need to know because we're advising our clients on this.
And it's hard to advise them when, like you said, they've been doing this for a number of years, and to tell them, well, this probably is inconsistent with the CNDI, but the views of the staff haven't really changed, I'd say, over the last 6 years. It's just sometimes the staff comment on certain areas in different industries, sometimes they don't. So, and that is a challenge that we try to educate our clients what may be inbounds and out of bounds. But a lot of times they are going to take their chances because they haven't seen comments in that area. But we just warn them, hey, there's risk here, and I know just from dealing with it for the last 6, 7 years, what the staff would likely object to or not object to. It's just sometimes they know that, and they know that the pitfall is, well, if the staff object, they might not give you, an off-ramp and make you quit cold turkey, and they have to realize that.
Yeah, and I think, again, that's very much why we've done this update now, is we understand all of your clients are not monitoring the comment letters like all of you probably are on this topic to see the trends that are coming out. The firm publications, whether it's a law firm or an audit firm, that are making publications about non-GAAP and trying to give the reoccurring themes that they're seeing for industries. And so what I believe needs to happen is everyone needs to take notice that there was updated guidance. While in my personal view, it simply memorializes the last 6 years of comments that we've had and the trends we've seen. At the end of the day, there's a reason why we've been commenting. It's because the prior guidance, people were still including those non-GAAP measures and adjustments. And so we needed to give everyone a tool in their toolkit to point to tell them, I don't think that you are supposed to be able to do this non-GAAP adjustment. And again, the SEC comment process, we're not here at the SEC to be the auditors, to be the advisors, to be the internal controls of a company. Disclosure controls and procedures, no matter what, apply to non-GAAP measures, which, John, I know you will appreciate that. And we're not part of those controls at the SEC. So whether the company gets a comment letter or not, that's not a control they should be relying upon for application of Regulation G, Item 10E of SK, or just in general, any of our rules and regulations. And I would warn everyone that I don't think people always appreciate is there can also be ICFR violations when it comes to a non-GAAP measure. If the adjustment that you're making truly is just removing a GAAP number that has ICFR controls over that GAAP number, and that number is materially wrong in the front part of the non-GAAP measure document, that could be a failure of the ICFR control that could even lead to a material weakness. Now, I'm not saying that ICFR is over non-GAAP completely, because it is disclosure controls and procedures. But the numbers going into that non-GAAP measure, sometimes they have ICFR controls over them. And if those numbers are wrong in the document, companies need to think about whether there's an ICFR control issue too, on top of disclosure and controls and procedures. Just real quickly, individually tailored accounting principles. That's another favorite 2016 CNDI. Our purpose with that update was to make it clear that it's not just for revenue. We've often seen in more recent years a lot of other non-GAAP adjustments beyond revenue that felt like tailored accounting adjustments. So we wanted to make it clear because companies had said, well, no, that CNDI is only meant for when you accelerate revenue. That is not the case. It's for any of the financial statement line items that you're adjusting for. And we gave a few examples of where that might be the case, changing from accrual basis to cash basis for revenue or expenses. We have a traditional one from the original CNDI on acceleration of revenue. But where we see the most frequently where this is a common area, it's companies that under US GAAP, they're supposed to be what I will call gross reporting for revenue or net reporting for revenue. And they're trying to show the non-GAAP adjustment and the vice versa. So if they're required to be gross, maybe they're deducting some transaction costs to present as if they were net like their peers, or if they're net, they're adding back some things to present as if they're gross revenue. That's a big no-no. If you actually don't qualify for gross reporting under 606, you should not be presenting a non-GAAP measure for that because the economics aren't the same as someone who is required to be gross reporting. The last one we updated, prominence, which we've already kind of referenced here. That is you can't have your non-GAAP measures be more prominent than your GAAP measures. And it's something that I thought it was a very clear guidance, and I think the rules actually are very clear on this space, but it's our number one non-GAAP comment area for 3 years in a row. You can't have a full non-GAAP income statement. That was in the previous guidance. After the December conference, I have received calls from companies saying, what do you mean I can't do a full non-GAAP income statement? I don't think you understand why we're doing it. It's part of the reconciliation. It's not allowed whether it's part of a reconciliation or it's a non-GAAP income statement. So really that update for that CNDI was meant to kind of, we took one CNDI and broke it out into 3. So that way it's more friendly when you read it to kind of group the topics that that CNDI was previously covering. And again, to really hone in on what does it mean for prominence. It includes ratios, your non-GAAP. If you have a non-GAAP number and a ratio, you need to provide the reconciliation of that number and everything, but also to get the point to the non-GAAP income statement and what is that. I'll pause there before jumping into the 2 new CNDIs, just in case any of my colleagues here have remarks.
I just want to make
Panelists?
one more comment. So you don't need to, make sure I got this right, but you don't need to be that concerned as we're advising our clients if you do decide to make a change and take out one of these adjustments you've been making for years, because you just need to fix it going forward. It is not what we think of as a restatement. You just, going forward, you recast the prior years as you report the new year in accordance with the new way of doing it. Do I have that right?
Historically, yes. The transition for when you have identified a non-GAAP measure or adjustment that could be misleading and you remove it, the transition has been that you need to go ahead and change it in the next period, and you also needed to make the change to the prior period. That was if you present comparable periods. There has not been a amended filings requirement historically. I know in the past there's been a lot of discussion of how there used to be more of an on-ramp for when those sort of adjustments were made. I think over the years, the reason why we've moved farther away from an on-ramp is because it is not uncommon that the discussions related to these adjustments take up to 6 months. It is not uncommon for us to see in the last 2 years multiple appeals by the issuer to the different levels within the division. And so it is possible. Live fact pattern one time was we said that we thought the adjustment and the measure was misleading in December. The company appealed multiple times, and it wasn't until April. And they already had gotten their Q1 earnings release. They've already gotten their Q4 earnings release out, another period. The dialogue had been going on since May of that year, the prior year. You know, when you're talking about 6-9 months level of discussion about there's a concern that the staff has presented, that's why there's no longer a better probably on-ramp, because after a 6-month to 9-month dialogue and more than one appeal, then it should be kind of obvious to the company, I would believe, that they should be preparing for transition and talking to their investors that it may not continue that measure. And so that's why I think there has been a shift in the on-ramp versus and the transition is just the length of time we're spending dialoguing with a company. Again, we want to appreciate non-GAAP measures aren't bad. They provide useful information. So we're willing to really dialogue, but it's more of the number of appeals that have been happening over the recent years that have seemed to be where companies have gotten more than one level of one earnings period where they've been able to continue to present it during that dialogue after we've already objected at least once.
The one takeaway on this is, yes, you can just go back and recast the prior years.
There's not an amendment filing.
Yeah.
Amended filing.
I do think that you should include a note or footnote to where you've done that to explain why the prior year numbers have changed.
Yeah, and I just want to jump in on this quickly. And Pat, maybe, I think you and I have probably both been in this situation in advising clients because there is no more off-ramp. I think there used to be an accommodation where if the SEC objected to a measure, then you would have a quarter, maybe even to the end of the year, so you didn't have to change your guidance, things like that, to socialize it. Just a little bit of time to prepare. That's no longer there. And so it only is going to apply if you have a measure that the SEC says you can't use. So it's very narrow in that respect. But Pat, you've been in situations where you get that answer at a very inconvenient time.
Yeah, and
right?
it is difficult to sort of plan for because a lot of these, whether it's earnings release or a periodic filing, that sometimes it's right at the end. And it's been signed off by the audit committee, signed off by the company and the officers, and it does put them in a difficult position on sort of transitioning and just taking that away, because then they have to reconvene, discuss it again, So it does put companies in a difficult position. But as I mentioned before, we do try to guide companies where we think we know where the staff is going, to try to at least tell them, hey, this isn't looking good. You need to start planning for this. But it is always a difficult balance there.
Yeah, so make sure, if you're in that discussion, make sure and plan out that timing, because if it happens when communications have already been approved, it sounds like the policy now is that you're going to have to go back and get all of that reapproved with the change. So that's different, and like I said, it won't happen to that many companies, hopefully, but it is definitely something to think about. So I think we'll move on from non-GAAP. I just real quickly, Lindsay, I heard what you said about restructuring, which sounds like restructuring in most cases as it's used today is okay. I just wanted to raise one other one that comes up a lot is acquisition-related costs. When I hear you talk about the changes here, I think you would view that similarly to restructuring. Do I have that right? So that's we're not expecting some raft of objections on acquisition-related costs anytime soon?
As long as you look at what's normal and you're not in that bucket, and again, one of those factors in normal is not more determinative over the other, so it's a combination of things, then I would say that's how the staff's thinking about it.
And I think you have to be careful as well what's included in restructuring costs and acquisition costs. Are they truly restructuring or acquisition costs? Sometimes companies will throw in the kitchen sink to try to say, hey, this is all restructuring or this is all acquisition costs. So just we try to advise our clients on that and what's in bounds and what's out of bounds.
It's kind of odd if after 3 years you're still backing out acquisition costs for an acquisition that happened 3, 4, 5 years ago. Starts to wonder, why is this not reoccurring?
Yeah, that's a fair point, and I've seen comments on acquisition related. I haven't seen an objection yet, so but I think people just need to think about it with your new framework, which I think is useful because, to be honest, when we put in that guidance, it was a comment that was issued a decade or more ago to a company that was backing out marketing expenses, and all we did when we wrote that guidance was we just took that comment and put it into the guidance. So I think it's really helpful that you sat down and thought about what would the framework be, because we just didn't, we weren't that thoughtful about it. So
There weren't the amount of non-GAAP adjustments back then either.
yeah.
So
John,
Mark, I
you
know
have
you
something?
wanted lawyer takeaways
Yep.
on all this. My takeaway is actually the CDI 102.10, which is the equal prominence one. That one applies to all of us. It isn't so new, but it's the first time it's all been written down. And once it's written down, it gives us ammo to get our clients to look at it, but it also gives Lindsay and enforcement ammo to come after us. And I really think that in virtually every situation, you need to be working your way through your non-GAAP measures and put in front of your director, your IR director, just put 102.10 in front of them and look at it, because it's scary when you read it, but it's what you've got to do.
And the original adopting release of non-GAAP actually referenced that it reinforced that some disclosures of non-GAAP financial measures could give rise to action under 10b-5. So to your point about enforcement and everything, in 2003, the adopting release for non-GAAP actually reminded companies that there is some enforcement of certain rules here beyond Reg G.
Okay, so hopefully that's as much non-GAAP as anyone can handle. Let's move
Definitely
on.
over the time we were supposed to spend on it, so.
Let's move on, Pat. Maybe you can talk a little bit about critical accounting estimates, which I know I've been around for a long time, but you did change some of the language, Lindsay, in a recent rule adoption. I guess maybe not so recent anymore, but Pat, I know that's a focus of yours and the staff, Lindsay. So Pat, maybe if you could talk a little bit about that. And Munir, I know you spend some time looking at those, and maybe you can jump in from a preparer's perspective as well.
Yeah, sure. As you mentioned, the staff updated MD&A item 303 for critical accounting estimates. It wasn't in there before, but it really didn't change anything. There was a 2003 interpretive release or guidance on MD&A that the staff used to refer to when they issued comments here, and they issued comments for a long time, in the early mid-2000s, kind of waned a little bit. Now that it's part of the rule itself, we're starting to see a little bit of an uptick in some of these comments related to critical accounting estimates. So just want to highlight some of the things that I've thought about, in terms of, what companies should really think about in terms of critical accounting estimates. And the first thing is, it's critical accounting estimates, not policies. We see this a lot with our clients and other companies that I've looked at before. So a lot of times companies would just copy and paste the significant accounting policies from the financial statement footnotes and drop it in the critical accounting estimates section. That's not really what it's there for. You can do that to provide some context behind some of these estimates, but it's really for companies to explain sort of the quantitative and qualitative factors that underline the estimates, judgments, assumptions used in these accounting areas. That's really what critical accounting estimates is there for. For example, rising interest rates right now. We're seeing the interest rate change a lot these days. How does that affect some of the assumptions in some of the accounting items, such as pension expense? It's going to have a significant impact, so companies should probably discuss the rising interest rates and what the variability in those interest rates do to some of the judgments and estimates and assumptions. Similarly, any sort of asset valuations. Discount rates are usually used in valuing some of the assets. How does that impact the discount rate, the rising interest rates? And lastly, just, given the economic environment we're in, the staff are seeing companies that are, restructuring, laying off employees. The focus this year is likely going to be on goodwill. And you can see on the slide here, there's an FRM section 9510, which Mark actually wrote, over 10 years ago probably, right? I mean, it's still in there, still holds true. And there's good guidance in there where you have a reporting unit that's at risk of an impairment. And what that guidance says is, here's some disclosure guidance associated with that. Talk about if there's a risk of impairment, the amount of goodwill allocated each unit, any changes in assumptions that could affect that fair value, any uncertainties. And the big one for me here is really the percentage by which the fair value of that unit exceeds the carrying value, or what we always call cushion, right? As that gets closer to the carrying value, companies should be providing these warning disclosures, because that's really what the staff is focused on. They're focused on, okay, not so much the actual impairment itself, it's really, what were some of the causes leading up to that, or the warning disclosures. It doesn't always happen in one quarter or a day or a week. It's usually a longer period where you start to see the business sort of decreasing and where it really leads to the impairment. And another thing the company should probably do, let's say that cushion is rather large and the fair value significantly in excess of the carrying value, provide an affirmative statement that the fair value is significantly in excess of the carrying value. I think that helps. And I guess the last point I want to make is I get a lot of questions on the sensitivity analyses and whether companies always need to provide a sensitivity analysis for each critical accounting estimate. And I'd say in certain cases where you can provide quantitative information that's available, in, let's say, again, interest rates, you can quantify that and the change in impact, sure, that should be part of your critical accounting estimates discussion. But in other instances, and we're talking to lawyers here, let's say litigation is one of the critical accounting estimates that they want to disclose. That's a lot of qualitative information. You can't really quantify that. So yes, we should show some sensitivity analysis when possible, but other times it's not possible and it's okay not to provide that.
And Manira, you spent some time, I think, refreshing on yours, right? Can you talk a little bit about what that process was like?
So a few comments from me. I'm going to make it real. You have to convert all this stuff to what actually happens out there. For us in December, that's our annual process. We meet with our audit committee. It's their responsibility to review all these critical accounting estimates. We sit with them, we walk them through, we talk about what these estimates are, and we also do a peer analysis. The peer analysis is done in more than one way. Like, what are our peers disclosing as critical accounting estimates, and how does that compare with ours, and why might they have something that we don't have, or vice versa. And since the crowd here, again, it's the legal profession, for us, our litigation footnote or our litigation estimates are a critical accounting estimate. And so we will actually provide these stats to the audit committee. How many pages are people disclosing? How many matters are they disclosing? It's our way of saying, is the content of our disclosures sort of comparable to what might be, and if not, why not? Having said all of that, sensitivity is a big deal. And interestingly, here we are talking about critical accounting estimates. When you think about a bank and you think about our loan loss reserves, obviously it is a critical accounting estimate. Multiple management meetings, agonizing over what's happening, predicting the macroeconomic scenarios that need to play out, quantitative, qualitative judgments. So while we meet the letter of the law, keeping it real, and we do provide sensitivities in some fashion or form to say, hey, if everything turned bad, well, what could be, how bad could this number be? We are providing something of that nature to the readers of the financial statements. It's not possible to, that's the reality, right? It's not possible to take all this management judgment, so many people getting in a room and looking at this and translating it to really capturing the essence of all of that in this discussion, but we try to do our best to make sure we're compliant, and all the points that Pat is making, like goodwill, pension, interest rate sensitivities, you'll see all of that be a part of our financials when we file it in February. So all of them are good reminders.
John, something from the legal perspective?
The lawyer takeaway, it's only one and a half pages long. I actually have a laminated copy on my desk. 9510, it's up there on the screen. It is something that you as lawyers can comment on when you read the financial statements. And what you're really doing is getting a forewarning there that an impairment is coming, and it makes a big difference if an impairment actually happens, that you've gotten the forewarning. So I urge you to go read 9510 and think about it when you are looking at a 10K and looking at the impairment discussion.
Yeah,
or
it's
the
not
goodwill
uncommon
discussion.
for the SEC staff to issue a comment asking about an impairment, and when did you start to think that this was a problem, and looking backwards to see why there wasn't that warning disclosure.
Every
That was the
impairment's
intent
looked
of
at
that
with
guidance.
20/20 hindsight.
Yep.
And this gives you the forewarning that protects you.
Even
Right.
if the impairment never comes, you gave a forewarning that there was a risk that there was one.
So let's move on to the next topic, which is waiver requests. We wanted to spend a little bit of time on this. So Lindsay, maybe you could talk a little bit about how that works, maybe some best practices, who's involved, things like that, because I think lawyers are often involved in those requests. And companies don't do those every year, maybe once every couple of years or once a decade, but it is pretty important when it does happen, because what you're asking for is you're asking to, in most cases, not provide audited financial statements of something, which can be a significant cost and burden. So it's a pretty important process. Lindsay, hoping you're willing to maybe walk people through what they can expect and how to do it the right way.
Yeah, and I will try to break this down nice and easy for everyone. First, just the dividing line. So if it's an accounting or auditing issue that your client has, they're writing to the Office of Chief Accountant of the SEC. That is the agency's Office of Chief Accountant. On their web page, the Office of Chief Accountant, they have the process of where to go for those letters. And it includes things like the audit committee and the auditors have to give a view on those letters when they write into the agency's Office of Chief Accountant. Again, that's accounting, auditor matters. Maybe sometimes, I know law firms sometimes are involved in some of those dialogues, but also for auditor independence issues. Again, that's going through the agency's Office of Chief Accountant. They are the ones that are the interpreter of GAAP. They have the relationship with the PCOB, the FASB, and the ISB. What the Division of Corporation Finance's Office of Chief Accountant, the office I lead, we focus on more the Regulation SX type of interpretive matters and waiver letters. And that is under Rule 313 of Regulation SX, and I think it's 801 for Article 8 for small business companies. And that's focusing on whether you want to waive financial statements required by Regulation SX, substitute financial statements required by Regulation SX, or the staff may require additional set of financial statements under this rule. So it's kind of all three buckets. Again, to warn everyone, it does allow us also an authority to require additional sets of financial statements. So on the Division of Corporation Finance's website, there is a link about interpretive guidance or interpretive requests. You go there, we have two kind of portals. One is an informal sort of what we call our phone hotline, which I'm sure some people in the room or your staff have used this hotline, where you're just asking, hey, where do I find guidance to this question? Or do you know what the staff's view is on this? And that's all informal, not binding, cannot be relied upon or quoted if you get a comment letter. Just to be clear, it's very much non-binding. We have had registrants write in saying, well, I learned about this in phone duty, and they tried to bind the staff to whatever representation they gave. It does not work. So cannot stress enough that hotline That goes to Office of Chief Counsel, Office of Chief Accountant in the division, Office of Small Business Policy, OMA. All of our support offices have a hotline. It's all non-binding guidance. Then there's when you want to actually do a formal request. When it comes to financial statements and getting to the Office of Chief Accountant in the division, we now have removed, we used to have an email, like DCAO letters at sec.gov. That's been removed, and it's simply a link on the website that you go in, you attach the letter, you provide a little information about who the request is from, who's the contact individual. I always recommend not only including counsel, but also the company's contact, because if someone is out on vacation, I'm sure your clients really want this letter dealt with as quickly as possible. So we always want more than one point of contact, and we will almost always require that the company be part of the call, because a lot of times the discussion is asking more about the transaction, and we want the people who actually are doing the transaction and financial reporting on that conversation, involved in that conversation. The waiver process in Rule 313 applies to financial statements under Regulation SX. It does not give us authority to waive whole entire filings. For example, Form 8K. We cannot waive that your client not file the Form 8K when they have a significant business acquisition. We might be able to waive the financial statements under Rule 305 related to the acquisition, but we can't waive the 8K requirement, so there would still be an 8K disclosing the information about the acquisition. We cannot change the filing deadlines. That's another common thing. You know, the commission has taken action in the past few years. For example, when there's a hurricane or storm, or the more recent is for COVID-19, the commission did some authority that it actually changed the filing deadline, provided an extended filing deadline. But Regulation SX, Rule 313, does not give anyone the power to extend filing timing. 12B25 is the only rule that you can go to get that additional 15 days for 10Ks and all, nothing beyond that. And then Regulation SK, again, our delegated authority does not extend to Regulation SK disclosure requirements, but we do get interpretive requests sometimes about Regulation SK disclosure requirements. Those are really interpretive. It's company writes in, or similar of, is something a business under Article 11 or not? Those are all interpretive requests where the company writes in, provides their view of what they think the interpretation is. We kind of agree or disagree on the interpretation. Some cases, there is a formal letter that is returned to the company. Other cases, they're not. So if you have a client that's ever done maybe a reverse merger and they're writing in because the CNDI on reverse merger and ICFR does not apply, but they are like, the company cannot do their ICFR assessment this year because the whole entire reporting entity has changed and there's no actual controls to test. So that's something that is interpretive related, that is written in, but there is no return letter back to the company. It's all an oral discussion with the company, their advisors, and for example, if we agree to it, it's us agreeing not to take action against the company, meaning the Division of Corporation Finance will not comment or refer the company to enforcement for not providing that assessment. It does not mean that assessment is waived, because there is not authority to waive it. Best practices on any interpretive request or waiver letter, but more specifically, since I think we deal with attorneys mostly in the acquired business waiver letters, is describe the transaction in detail, give us the results and the components of all the significance tests, the two parts of the income test, the investment test and the asset tests. And then also, was there anything leading up before and after the transaction that is significant? Sometimes companies have done a whole reorganization or recapitalization right before, and so that is important to why they believe that acquisition is no longer significant, or they've done multiple acquisitions subsequently that they don't believe in an IPO scenario that this one acquisition 2 years ago that the rules required the financial statements to be included, we don't believe it's significant anymore because we've had multiple acquisitions. So as complete as your letter can be, that's going to help us process it faster. When the amendments to Rule 305, 314, and Article 11 were done in 2020, they really took care of all the low-hanging fruit for our waiver letter process. So all we receive, we receive less letters now, but we receive only the really complicated ones. Multiple equity structures. You know, I've done like 10 transactions and this one's popping, but this one's not. And by the way, I've disposed of all of them. Like, it is the complex letters and facts patterns we see now, they take more time than the low-hanging fruit ever did. So that's why we're encouraging people to have a more complete letter than we did in the past, because we're trying to not have like 10 rounds of phone calls. We're trying to be able to digest the letter, think about the questions. In my perfect world, I don't think my staff would agree with this, but in my perfect world, we have one call and we hopefully can get, after that call, get to a conclusion. And so this idea of having a more fulsome letter is to try to get to, in these complex fact patterns, a lower lead time of the discussion and getting you an answer. I can't promise that it will be that case every time because they're complex, but that is the goal with this more fulsome letter. And last, again, cannot stress enough, getting the financial reporting people on the call or people involved in the transactions, because I will say my staff might think I have very different questions than my predecessors maybe had on some of these fact patterns. And so I want to know, like, what is the business reason for the acquisition? Like, okay, if you're going to not include this whole set of financial statements because you don't believe it's meaningful because the trends have increased, like they've added additional business lines now. Well, then how are you going to explain that to your investor, though, in MD&A? Are you going to discuss that in MD&A? Are you going to tell investors? Because that trend information, there's a reason why we have item 303. So again, getting the people who are writing the documents for your filings and involved in the transactions on the call is helpful, because we often have a robust level of questions if the letter's not complete.
And I want to hear from John and Pat on this, since I know you advise companies that are going through this. Any observations recently on the waiver process?
Well, my observation, again, is, my lawyer point. Lawyers often get involved in reviewing or helping with these letters. The 313 has just 2 sentences. The first sentence talks about omitting things. The second sentence talks about what you might offer up to replace what you're going to omit. And in terms of the secret sauce of a successful waiver request, spend time with your client. Just hammer home, what is it that we can offer to investors that will replace what we're omitting? And just spend your time with the clients and get that into the letter. And my personal experience has been that is the secret sauce that gets a successful request.
Pat, you do this a lot.
Yeah, on my end, what we're seeing is a downtick in number of waiver letters. A lot of it's because 305, when they added the revenue component, it got rid of a lot of the easy waiver letters that the staff would receive. Now it's the more difficult ones that we're seeing, the more complex, where we have to explain a lot more about what's going on and the reasons why. For example, if a company has a complex equity structure where maybe they have large non-controlling interests, so their market cap is very low, but the company's pretty big, well, any sort of acquisition they have might trip the investment test. In those instances, the staff has been pretty consistent about looking through that fact pattern. They haven't really gotten tougher. It's the same as it has always been about, okay, if it makes sense, yeah, we'll let you not include those financial statements, but where they think that it's necessary for an investor, they'll probably say no or substitute it with something else.
Frequently the substitution of the statement of assets acquired and liabilities assumed and the revenue and expenses, yeah.
Okay, so I guess one thing I learned, maybe my approach of just granting everything that was put in front of me that wasn't quite the right approach.
There was also no amendments. You left at the heat of the amendments.
Okay, so let's move on. Manira, let's get you involved here. There are actually some interesting developments at the FASB, and this project on segment reporting is getting a lot of attention. Would you mind going through what they're doing?
So segment reporting to me has always been this interesting area in GAAP where the financial statements are prepared from the eyes of management, which means it's I almost call it like pseudo GAAP, maybe, because you do have a bunch of revenue sharing happening between your lines of businesses. You have all these expenses that get allocated. You're assigning equity to these lines of businesses, or I call them lines of businesses, reportable segments, using technical literature. They're not legal entities. And so there are a lot of decisions that companies are making as they put together their segment reporting. And one company's decision may be different from someone else's, which may impact then comparability and how all of this is viewed by the investor community. Ultimately, the objective behind segment reporting, you're putting together the main areas of business of your company so investors can understand your company's business, they can understand performance, they can understand cash flows. That's supposed to be the idea. I'll go to SEC major no-nos in today's world. When they're looking at things, and I don't want this to be an accounting technical discussion, I mean, segment reporting has very specific nuances in GAAP and thresholds and quantitative tests for when something should be reported separately, what should be the amount of separation you should have vis-a-vis revenue, when can things be put together. There's all this complicated stuff on segment reporting, but generally, the SEC is going to focus on I'll say over aggregation. If you have one single segment for your company, they're probably going to look at it and say, is that really right? If your CEO is getting granular information, that there might be implications to segment reporting. If that's how the company is being managed, then how are you not sharing that with your investor community? I struggle with the last one a little bit in today's day and time, given that you have Tableau dashboards and real-time reporting and drill-down capabilities. I think everyone is seeing everything, but I think how the company is being managed can generally be fairly apparent. In today's day and time, another couple of no-nos, having consolidated segment profitability measures outside of footnotes, that's going to get their attention as well. Having multiple profitability measures, that's another one that can get their attention. On things to do versus things not to do, I think in multiple different forums you're hearing from the SEC, hey, help your investors understand your business. You can provide additional granular information if that's helpful. And so I'll just pick on our company. Being a bank, one of our reportable segments is consumer lending. In consumer lending, you could have home lending, credit card lending, auto lending, and we do try to break revenue down into all these different components. We try to provide some drivers. It could be number of originations, could be debit card, credit card volume of what people are swiping. Just realize that while this is all great and good for investors to understand, that DCP and internal controls come into play into all these different metrics, which are not purely financial, they're sort of financial. So you have to be, if you're going to respect the spirit of what needs to be done here, that's great. Just make sure that you're also checking all the boxes from an internal control standpoint. That then takes me to where is the world going? And this is the proposed amendments that you see here to segment reporting. This is where the FASB is looking at segment reporting guidance saying, what should we do here? So they're not changing anything with this aggregation or identification criteria. They're leaving that alone, but they are focused on expenses. Expenses seems to be an area where there is a great deal of aggregation, and they're saying, hey, let's double click and offer investors a little bit more. And so if I was to, again, pick on my own company, we disclose expenses as a single line in each of our operating segments. But I can tell you that our CEO is interested in understanding, well, what do the lines of businesses or the reportable segments, what do their heads control by way of expenses versus not control, because everyone is trying to be efficient, everyone is trying to control their costs. And so we do look at his packages and see, well, what is the level of granularity he's receiving? Thankfully it's no more than that, but effectively what would happen under this proposed guidance is you would share with the investor community the level of disaggregation that you're sharing with your chief operating decision maker. I do not like that term. That term does not go over well in my company. They're like, who now? But here we go. This is the accountants. And so they in this new proposed guidance, will require that you actually provide the name and title of who that chief operating decision maker is going forward. The new guidance also has a couple other interesting twists, and that were previously no-nos, a la multiple measures of profitability are now allowed, which they weren't before. I think there was something else that I'm missing. You guys will have to keep me straight on this. I'm going to turn it over to them because we don't have some of this stuff, so I want to hear from my accounting friends on how these multiple measures will be viewed. I know what the other one is. If you only have a single segment, then going forward, you have to provide additional disclosures. Obviously not a problem for us if we haven't been focused on it. But guys, what does that mean to your clients? I'd be curious.
Well, I don't know if you want me to start. I guess not so much from our client standpoint. They welcome multiple performance measures. They want to show more, and they have, and of course the staff have commented and they had to take it out. I think the challenge is from a regulatory standpoint, if you have a single segment and you're allowed to present this, let's call it alternative profitability measure for segments, what does that do for the non-GAAP rules? And that's what makes it tough for the staff. And the staff has mentioned that to the FASB, and sometimes the FASB just says, well, too bad, so sad. And they're just going to say, that's what we want to do. But, Lindsay, it provides pressure on you all because that's GAAP. And it's pretty clear in item 10E that if it's GAAP, non-GAAP rules don't apply. If not just required by GAAP, but also expressly permitted by GAAP. So even if it's an option, 10E doesn't apply.
There is a little bit more in the 2003 adopting release about that too, about what does that mean about permitted versus required. And on the plane here, I actually reread the 2003 adopting release to be able to think about some of these things. And it's interesting because there is a difference though about whether you're permitted versus required. If you're required, you definitely don't meet the definition of a non-GAAP measure. So if 280 required them to provide an alternative measure or two measures in all cases, that's a little bit different than just permitted. The release does suggest that there is some authority the SEC could take to say that possibly it's not a non-GAAP measure because permitting versus requiring is different. But again, this is still just not in final stages yet. So the staff has not come out to give any formal views of whether how the definition of non-GAAP measures in item 10E and this new proposal play into the fact of the multiple measures.
John, I want to get to you in 1 second. I just wanted to make one point about how this is going to get pretty interesting for non-GAAP. The single segment presentation will be pretty interesting because now those companies will be presenting their profitability measure that won't be a non-GAAP measure. If you're a multiple segment company, there's that guidance that says if you add segment A, B, and C, it now becomes a non-GAAP measure. It's no longer protected by GAAP. And so this is going to create a pretty interesting situation where you could have two companies doing the same thing. They just have multiple segments, but let's say they have the same exact profitability measure. One of them is just going to be able to use it with impunity. The other one is going to have to call it a non-GAAP measure and run the risk of possibly having the staff
when it's consolidated.
Object to it. Yes. So
but again,
that's
this
going to create
permission
an
versus
interesting
permitted
situation.
versus required in the 2003 adopting release, I think it's going to potentially put some tension on even that single segment, depending on where the dialogue goes.
Yeah, I think that's what
that'll
makes
be
it
pretty
tough,
interesting.
though. Yeah, because the
Okay, so to
rule
bring
is
this
pretty
back
clear.
to
right?
lawyers. You can read the hundreds of pages they put out about segments, and some of us do. But where we for sure come in is on the disclosure side, and in particular, the 8Ks that can flow out of all of this. If you've got challenges at your company, you often end up with new leadership. Once you get new leadership, you end up with a new chief operating decision maker. You then can end up with new segments. Once you have new segments and you recast the prior years, you need an 8K to do that before you can finance. Often new segments trigger impairments, which is a different 8K requirement. Often new segments are involved in restructuring, which is yet another 8K requirement. And we as lawyers need to be familiar with the 205 and 206 8K requirements and how this all interrelates. Because while all the accountants are debating this, they will come to you and ask you to sort out the disclosure pieces.
And the filing requirements.
So John, those
And the
are-
filing
that-
requirements. So
that's-
my advice to all of you is to spend your time, first of all, on that, then later on if you want to try to understand all this.
That's really good advice because I think I've pushed my memories of this to the back of my mind. But in 2020, that's exactly what happened. We had a new CEO. He wanted to manage the business differently. He completely redid what our reportable segments look like, and it was a lot of work to go back and collect the right information under proper internal controls to have your disclosures, right, and do all the assessments that you're talking about in a short period of time to be able to get that out with all the 8K filings. That's exactly where we were. So good advice.
Great. So I'm going to call an audible here, and we're going to skip over crypto assets because I've heard it discussed on a couple other panels. And so there are a couple points on the slide about where to get that guidance, but since it's already been discussed, I think we'll just move past it, which brings us back to you, Manira, and what else the FASB is working on.
I think this room is going to get a healthy dose of accounting now. So let's talk about disaggregation of income statement. I think you're hearing a theme. Disaggregation is the theme. And in this instance, it's about the income statement. The banking business, again, see, people think of banks as being bad, but we're so good when it comes to reporting. We have our own rules. There's Rule 9, yeah, I know. There's Rule 904 of SX that literally dictates what our income statement should look like, and it has a lot of detail and granularity. In comparison, as I was looking at this FASB project, I'm really surprised by what other companies do, because they will literally have one line item, SG&A, like it's just one big blob, and that's been okay. And they won't have a lot by way of accounting policies that describe what's in SG&A. So this project is about essentially adding a little bit more guidance to all these other companies that might have let's say, lack disaggregation in their income statement. Very specifically, it focuses on what's called natural expenses, and when you have things like certain expenses are expensed, others are capitalized, what exactly is going on with expenses that are incurred versus expenses incurred versus capitalized, a little bit more detail on what's happening with employee compensation, and there are obviously lots of nuances in who's an employee versus not and what not have you. So that's at a very high level. I'm not getting technical here. It's just good to know that that's where the winds are blowing on that one. I'm a little bit more passionate about income taxes. So maybe I'll go there and then you guys can come back and fill in the blanks on anything else you think this crowd needs to know. On income taxes, I'll just a little story here. Each quarter when we release earnings, the head of IR comes to my monthly leadership meeting after earnings is done, and he talks to my two downs, and we talk about, well, what did we do right? Was there clarity in our message? Was our content good? Were we timely with our filings? And it gives my team the opportunity to ask him, hey, questions about what are investors really asking you about, kind of helps us appreciate what the IR director is looking at. Well, last quarter we had a $500 million discrete tax benefit, obviously sizable. So one of my team members asked the IR director any questions on taxes. I mean, this is a sizable amount, and he said none. He said he got one question, which was, what is going to be your effective tax rate for next year? So this is the real world on where things are versus where the FASB is. The FASB would like for us on income taxes to talk about how much taxes were paid federally for states in foreign jurisdictions. Well, that's okay, we can do that, no problem there. Then they want us to take the state taxes paid and start disaggregating based on a 5% threshold for every state that you're paying taxes to. So obviously when you think about Wells, big in California, big in New York, can you imagine what that listing is going to look like? Gets interesting. Do the same thing on the foreign front. Well, foreign is less than 5% of our business, but here we are stuck with whatever the threshold is going to be, doing that disaggregation. And then tax credits, permanent non-deductible items, every single aspect of taxes, just think disaggregation. And at the end of the day, we're going to put all this information in our filing when we didn't get a single question on what was a pretty major impacted quarter from a tax standpoint. So that's where the world is. I'm going to pause there and maybe give you guys a chance to add your thoughts.
Yeah, just one point I'd make is that I know most people probably know that goodwill was on the agenda at one point. It was sort of a back to the future situation where they're going to go back and amortize it. But I think what happened there, listening to Rich Jones, the chair of the FASB, talk about it, is that people were split on what to do. They couldn't really articulate what the improvement was going to be if they made a change, so they ended up dropping the project. So
I would have liked to have seen that one gone, but only because a goodwill exercise, we think about your budgets, right? Getting 1 year right can be very interesting. Goodwill, you're trying to put out cash flows for 5 years. Like, it's a crystal ball exercise. I'm not a fan, but nonetheless, you got to respect the rules for what they are. So.
Right. So I want to move on quick, John. I want to give you a little bit of time to talk about the PCAOB because I think sometimes, people, just a couple minutes.
Yeah, I'm looking. I was allocated 10 minutes, and obviously I've got 1 minute if we're going to do takeaways. So I'm going to skip 5 of the points I was going to make. But one of the things I guess I thought I would talk about, they are certainly intensifying their inspection process. And I guess just if we think about it as lawyers, can you imagine if our work was being reviewed, everything we write down and the advice we give was being reviewed and we were being critiqued? Because that's exactly what's happening to the audit firms. The PCAOB is inspecting them. They go through and look at every step of an audit. And they're doing it with more intensity. And I mention that because as we deal with the auditors on a regular basis, I think we have to realize what they're going through and spending time trying to help them have the documentation, help them with their risk analysis, help them, they need this stuff to be able to do their job, as obnoxious or as annoying as it may be to us, not obnoxious, annoying it be to us and our clients to provide it to them. They're going to be inspected. They're going to be called on the carpet about it, potentially. And I think we have to be understanding and be helpful, because that's how you get to the end of the road when your auditors, when auditors surface in a lot of the issues we deal with.
And it has an effect, right? When the PCAOB tells us to do something, go deeper on something, then the company is going to have to come along with us on whatever their recommendations are.
But you have to document it.
Yeah.
And documenting it means helping you document it, because it's the way you get to the finish line on whatever the issue is.
Right. So I think that brings us to the end. John, you said you had to delete some of your takeaways. Did you want to give them now, since we have a little bit of time? Did you have more?
Well, aren't you going to let each of us do it?
I'm going to let you start.
What?
I'm
Oh,
gonna
I
let
get
you
to
start.
start.
Yep.
Oh, okay. Well, I've been giving takeaways all through, so I won't repeat those. But I did actually thought I'd mention one that has nothing to do with what we've been talking about before. But whenever I encounter an accounting issue or a financial reporting issue and that I'm advising on, I always try to remember to ask 3 questions, which may sound fairly simple, but it's amazing how oftentimes people don't think about them. The first one is, have you told your audit committee? Or when are you going to tell them, and what are you going to tell them? The second one is, have you told your auditors? And when are you going to tell them, and what are you going to tell them? And the third is, what about controls? What do controls have to do with this issue? Are there shortcomings in controls, and what the implications of controls are? And basically every accounting issue that I encounter, I make sure that we ask those 3 questions as we're talking our way through it. So that's my takeaway. I recommend you do the same.
That's great advice, and I think that's a great place to stop. I do have a message to read for everyone, so I'll just read it. Please head to the Crown Room for lunch, followed by the David S. Reuter Luncheon Address being given by Chief Justice Seitz from the Delaware Supreme Court. We'll start sessions again at 1:15 p.m. And just hopefully everybody enjoyed this panel. Thank you so much for participating. Thought it was great.